In the world of investing, many seek a portfolio that delivers not just growth, but stable, reliable passive income. This is the core concept of the Dividend Fortress. Imagine a stronghold capable of withstanding economic storms and market volatility. This fortress not only protects your assets, but consistently provides resources in the form of dividend income to sustain and strengthen itself over time. This is not a get-rich-quick scheme. It is a long-term philosophy focused on building a growing stream of passive income from high-quality companies. Why are dividends the foundation of this strategy? First, they are a proof of a company's financial health. A business that can consistently pay and increase its dividend is typically well established with strong cash flow. Second, unlike capital gains, dividends are tangible cash deposited directly into your account. This real income can be reinvested to accelerate your wealth. Finally, during a bear market, quality companies often continue to pay dividends, providing a financial and psychological cushion and an opportunity to acquire more shares at a discount. The true power of this strategy lies in compounding. When you reinvest the dividends you receive, you purchase more shares of the asset. Those new shares then generate their own dividends in the next payout period. This process creates a powerful snowball effect, exponentially accelerating the growth of your portfolio over the long term. It's a simple yet profoundly effective mechanism for wealth creation, turning a small stream of income into a significant river of cash flow over time. While you could pick individual stocks, exchange-traded funds, or ETFs simplify this process dramatically. With a single purchase, you achieve instant diversification across dozens or even hundreds of companies, mitigating single stock risk. ETFs are also known for their low expense ratios, meaning more of your returns stay in your pocket. They offer full transparency into their holdings and are traded on exchanges just like stocks, providing excellent liquidity and flexibility. This accessibility makes them the ideal tool for building. A balanced fortress is built on three pillars. The first is the dividend growth engine. This is the heart of your fortress. It is represented by an ETF that focuses on companies with a long track record of consistently increasing their dividend payments year after year. The primary goal here isn't the highest yield today, but the sustainable growth of that yield tomorrow. This pillar ensures your future passive income stream outpaces inflation and grows substantially over time. When selecting an ETF for this pillar, look for one that tracks a Dividend Growth or Dividend Achievers Index. Internationally, examples include ETFs following the S&P 500 Dividend Aristocrats Index. The key metric to analyze is the fund's historical dividend growth rate, not just its current yield. Also, ensure it has a low expense ratio and a substantial amount of assets under management, which indicates liquidity and stability. Your goal is to find a vehicle for steady, reliable dividend increases. The second pillar is the high-yield income source. This pillar acts as your primary income generator in the present. It is represented by an ETF that invests in companies offering a high dividend yield right now. While these companies may not grow their dividends as rapidly as those in the first pillar, they provide a significant and immediate cash flow. This is crucial for both reinvestment and eventually covering living expenses. In a local market like Indonesia, an example would be an ETF tracking the IDX High Dividend 20 Index. For a high-yield ETF, a key selection criterion is its underlying index. Look for indices that screen for both high yield and financial quality. Be cautious of what's known as a yield trap, an unusually high yield that results from a collapsing stock price due to fundamental business problems. A well-diversified ETF helps mitigate this risk, but it's still critical to understand the index methodology to ensure you're not just chasing the highest number, but a sustainable high yield from quality businesses. The third and final pillar is the foundation of stability and diversification. This pillar's purpose is to ground your portfolio, provide broad market exposure, and reduce overall volatility. It helps balance the portfolio's risk by capturing the growth of the market as a whole, ensuring you are not solely dependent on dividend-paying stocks. This foundation provides resilience and smooths out the journey, which is critical for long-term success. An excellent choice for the stability pillar is an ETF that tracks a broad market index. A classic international example is an S&P 500 ETF, which gives you exposure to the largest companies in the world. For investors focusing on a specific country, a local broad market index ETF is ideal, such as one tracking the IDX 30 or LQ45 in Indonesia. This provides a solid base for your portfolio, anchored in the performance of the largest and most liquid companies in a given market. With the three pillars defined, the next step is asset allocation. There is no single allocation that fits everyone. Your ideal mix depends on your age, time horizon, and risk tolerance. We will now explore three distinct allocation models: conservative, balanced, and aggressive, to serve as a starting point for structuring your own Dividend Fortress. This framework will help you translate the theory of the three pillars into a concrete investment plan. First, the conservative model. This is suitable for investors nearing retirement or those who prioritize immediate cash flow. The allocation is 50% to the high-yield pillar, 30% to the dividend growth pillar, and 20% to the stability pillar. The rationale is to maximize current income while still retaining a component for future growth and a solid, diversified foundation. This model favors income generation today over maximum growth tomorrow. Next is the balanced model, designed for the majority of investors in their prime working years. This model seeks a harmony between current income and long-term growth. The allocation is a simple split: 40% to dividend growth, 40% to high yield, and the remaining 20% to stability. This creates an equilibrium, generating solid income for reinvestment while aggressively pursuing future dividend growth, all anchored by a stable market foundation. Finally, the aggressive model. This is for younger investors with a very long time horizon and higher risk tolerance. Here, the allocation is 50% to dividend growth, 30% to high yield, and 20% to stability. The focus is heavily weighted towards the growth engine to maximize the power of compounding over several decades. Current income is less of a priority than the potential for the largest total portfolio value in the distant future. Building the fortress is just the beginning. Maintaining it is key. The most powerful tool for maintenance is dividend reinvestment. Whether through an automated dividend reinvestment plan, or DRIP, or done manually, the practice of using dividends to buy more shares is the fuel for compounding. For example, some jurisdictions offer significant tax advantages for reinvesting dividends, which can further accelerate growth. Consistently reinvesting is non-negotiable for maximizing the potential of your fortress. Over time, your portfolio's original allocation will drift as some assets outperform others. This is where rebalancing becomes essential. Rebalancing is the disciplined process of selling a portion of your outperforming assets and buying more of your underperforming ones to return to your target allocation. This is critical for risk management, as it prevents your portfolio from becoming overly concentrated in a single, high-flying asset class. It enforces a rational, sell high, buy low discipline. How often should you rebalance? There are two common approaches. The first is time-based, where you rebalance on a fixed schedule, such as every 6 or 12 months. This is simple and easy to implement. The second is threshold-based, where you only rebalance when an asset class deviates from its target by a predetermined amount, for instance, 5%. This method can be more efficient, triggering action only when necessary. Choose the method that best fits your temperament and stick to it. Finally, the most important component is your mindset. You must learn to ignore short-term market noise. Train yourself to focus on the growing stream of dividend cash flow, not the daily price fluctuations. Success with this strategy is measured in decades, not months. The keys are patience and consistency. Continue to invest regularly, reinvest your dividends, rebalance with discipline, and allow time to work its magic. That is how you guard your fortress for a lifetime.